Okay, let's dive in. There's a stat from the sources we've been looking at that just it really stopped me in my tracks. Stablecoins, right? Those digital currencies you might have heard about.
Yeah.
They processed more transaction volume in 2024 than Visa and Mastercard combined.
Wow. Yeah, that number,
Yeah.
it really does hit home, doesn't it?
Yeah.
Shows the scale, the
Yeah.
speed of their growth.
It absolutely does. And that, dramatic growth is exactly why we're doing this deep dive today. We've got a pile of recent analyses, reports, basically covering things from maybe 2023 up to 2025. And our mission for you listening is to unpack what these things are, figure out why they're booming like this right now, look at the opportunities, and really importantly, shine a light on the risks, because there are definitely risks.
For sure. So we'll start with the fundamentals, the absolute basics. Then we'll get into those growth numbers you mentioned. We'll look at how they're being used in the real world, way beyond just crypto trading.
Right.
Then there's the whole regulatory maze. It's getting complex globally. And yeah, the risks. We have to talk about some of those big failures. And finally, kind of see where they fit in the bigger picture, next to things like CBDCs, Central Bank Digital Currencies.
Right. Get ready for some genuinely surprising facts here. We want to make this whole complex topic clearer, help you understand what's really significant about stablecoins today.
It is fascinating, though, how quickly something that started as like a niche crypto tool is now. Or it's potentially becoming this fundamental layer for global finance.
Okay, let's unpack that then. At their core, what are stablecoins, really?
Well, think of them as a specific type of digital asset. They're designed purely to keep a stable value. So unlike Bitcoin or Ethereum, which jump all over the place.
Yeah, wild.
Exactly. Stablecoins aim to be predictable. Usually they're pegged to a traditional currency, mostly the US dollar, though, some try pegging to commodities or even other cryptos. But the big ones, the ones driving this growth, they're dollar pegged.
So the main idea is just stability inside that crazy crypto world.
That was the starting point, yeah, to kind of smooth out those wild price swings, make them usable as like a reliable store of value or way to pay within that crypto ecosystem. But the sources also point out they have these other advantages built in, things like potentially lower transaction fees, much faster settlement times, and you can send them anywhere globally, often easier than using old school banks.
And crucially, they're not all built the same way. The reports really hammered this point home, the different types.
Absolutely correct. And understanding that difference is vital because it ties directly to the risks involved. It basically comes down to how they keep that peg. So 3 main types. The most common are fiat-collateralized. These aim for that one-to-one peg, say 1 coin equals $1. And they're backed by actual reserves held in traditional assets. Things like real fiat currency, government bonds, bank deposits.
Okay, like Tether USDT or USDC, those big ones.
Exactly. Those are the dominant examples. And for them, credibility really hangs on regular audits, transparency. You need to trust that the backing is actually there.
Right, so you're trusting the company issuing it and whoever holds their money. What's the biggest risk there, according to the sources, before we get to the other types?
Well, the main vulnerability is the reserves themselves. Are they really enough? Are they liquid? Can they be accessed quickly? Is the issuer being upfront about it? The sources also note something interesting. The issuers often keep the interest earned on those massive reserve holdings.
Wait, really? Billions of dollars just sitting in T-bills earning interest for the company.
Pretty much. It's a huge incentive. The sources point this out. It makes issuing stablecoins incredibly profitable, even if they don't charge big transaction fees. That's a key insight, right? It explains why companies like Tether and Circle are pushing so hard. It's not just a service, it's a massive business model.
Wow. Okay, that clicks. So what are the other types then?
Okay, next you have crypto-collateralized stablecoins. These use other cryptocurrencies as the collateral, as the backing.
So like using Bitcoin to back a stablecoin?
Yeah, or Ether.
Yeah.
But because those backing cryptos are volatile themselves, these stablecoins have to be over-collateralized, meaning you have to lock up, say, $150 worth of Ether to get $100 worth of this stablecoin.
Ah, a buffer.
Exactly, a buffer against price drops. MakerDAO's DAI is a well-known example. These are usually run by smart contracts code on the blockchain that automatically sell off the collateral if its value falls too low to protect the peg.
That sounds, well, inherently a bit more complex, and maybe riskier if the whole crypto market crashes.
It is more complex, definitely. And it carries risks tied to those market crashes, and also the reliability of the smart contracts themselves. Bugs in the code can be a disaster. And finally, the third type, algorithmic stablecoins. These, well, they don't have direct collateral like cash or crypto.
No backing at all.
Yeah.
How do they stay stable then?
They rely entirely on math,
Yeah.
algorithms, and market incentives. The idea is the code automatically adjusts the supply. If the price goes above the peg, it mints more coins to bring it down. If it falls below, it burns coins, taking them out of circulation to push the price back up.
That sounds incredibly fragile. Is this the kind that blew up spectacularly?
That's the one. The Terra USD, or UST, collapsed back in May 2022. Is the prime example, a really stark one, of just how fragile this model can be.
Yeah.
It completely failed under market stress because there was nothing real backing it, just code and incentives that couldn't hold up. Billions lost.
Okay, so a really, really crucial point from the sources here is that stability is not the same across the board.
Not even close. The sources really stress this. How stable they actually are and the kinds of risks they face, it varies hugely depending on the type. Fiat-backed. You've got centralization risk, counterparty risk, trusting the issuer, trusting the banks. Crypto-backed are vulnerable to those big market downturns, mass liquidations, but algorithmic. As UST showed, they're by far the most fragile. Prone to bank runs, total loss of confidence.
And why does understanding these types matter so much for you, the listener?
Because you absolutely have to know what kind of stablecoin you're dealing with to judge its risk and reliability.
Yeah.
You just can't assume they're all equally safe because they call themselves stable. The backing mechanism, or lack of it, tells you everything about where things could go wrong.
Makes perfect sense. Okay, now let's talk about this boom. The source material, it paints this picture of just explosive growth recently, like 2023 to 2025, way beyond that first stack.
Oh, it's been incredible. The total market cap, it went from maybe $20 billion back in 2020 to, get this, $246 billion by May 2025. And just the dollar-backed ones alone, they crossed $200 billion in assets under management by March 2025. The average daily supply grew about 28% year over year. The total supply jumped something like 63% in just 1 year, from about $138 billion to $225 billion between Feb 2024 and Feb 2025.
Those numbers are huge. But back to that stat you opened with, surpassing Visa and Mastercard in transaction volume. That still sounds almost impossible. How is that calculated? What kind of transactions are these?
Right, it's a fair question. That specific number, the $27.6 trillion in 2024 transactions, comes from analyzing the actual movements on the blockchains. And yes, it did surpass the combined reported volumes of Visa and Mastercard for that period. Over the 12 months to Feb 2025, total transfer volume hit $35 trillion. Monthly volumes just exploded, up 150% year on year by Feb 2025.
Okay, but what's in that volume? Is it people buying coffee?
Not mostly, no. That's the key difference. This volume includes a lot of things. Transfers between crypto exchanges, big movements within DeFi protocols, peer-to-peer payments, institutional flows. It's not just consumer point of sale like Visa or Mastercard primarily track. But even with that caveat, the sheer scale of value being moved is immense, and it's growing incredibly fast.
Okay, that clarifies it a bit. Still, $35 trillion moved in a year. That's enormous. Who are the main players here? Who's handling all that volume and value?
Well, the market is still heavily dominated by two names. Tether, which is USDT, and Circle's USDC.
Right.
As of early 2025, they held something like over 90% of the total market share combined. Tether's the giant, with around 62%, over $143 billion market cap. Circle's USDC is over $58 billion. And it's important, as we said, they mostly back these with high-quality stuff like U.S. Treasury bills, money market funds, which interestingly makes them significant players of those traditional money markets now, too.
Are we seeing any new contenders starting to challenge them? Any new players making waves?
Yeah, definitely. We're seeing new ones gain traction. Some have different models, some are backed by big names. There's Athena USDD, which uses a more complex synthetic dollar approach, not traditional reserves. It's hit almost $6 billion market cap. And then there's PayPal USD, PYUSD, issued by, PayPal. It's nearing $1 billion. And the sources noted PayPal's already using it for real business payments, like paying their accounting firm, EY. That's a concrete example of it moving beyond just crypto trading.
And it's not just crypto companies anymore, is it? We're seeing actual banks, traditional finance getting involved. That feels like a really big shift mentioned in the reports.
That's a huge trend the sources are tracking. Circle, for instance, has partnered with major global banks. We're talking Standard Chartered, Deutsche Bank, BNY Mellon, a whole list.
To do what exactly?
To build a new cross-border payments network, specifically using stablecoins. This is massive. It positions stablecoins not just as an internal crypto tool, but as a direct competitor to legacy systems like SWIFT for global money movement, for interbank transfers. Banks are seeing the potential efficiency gains and are actively looking at plugging into this.
What about regular people? Is user adoption growing too? Are more individuals actually using these things?
Yeah, user adoption has surged. The number of active stablecoin wallets actually holding or using them grew over 50%, like 53% in just 1 year. Went from around 19.6 million to 30 million between Feb 2024 and Feb 2025. And while crypto trading is still a big driver, the sources definitely point to growing use for just payments, remittances, other financial stuff globally. It's interesting, too, that sources mention geographic differences, like Tether seems bigger in Asia and Europe, while USDC is stronger in North America.
So that shift you mentioned earlier
Yeah.
from just being a crypto trading tool,
Yeah.
it's really happening now. It's moving into wider finance.
Exactly. The data makes it pretty clear. Stablecoins are moving beyond being just a safe place to park cash during crypto volatility. The growth in B2B payments, that was $36 billion out of $94 billion total volume in early 2025, and this integration to institutional networks. It shows they're becoming actual financial infrastructure. Firms are saying they're getting ready too, like 90% surveyed are looking into stablecoin payments, 86% feel ready.
So this isn't just niche crypto news anymore. This is potentially a fundamental shift in global finance happening right now.
Absolutely. This kind of growth, this integration, it signals a really fundamental change in how money might move globally. It's unfolding as we speak.
Which leads us perfectly into the real world impact. So beyond trading, where are stablecoins actually being used today? How does this affect businesses, individuals?
Right. So as we said, the shift is real. They're becoming these versatile assets. Yeah. A huge one is cross-border payments and remittances.
Sending money internationally.
Exactly. Think about the usual fees, the delays. Stablecoins can bypass a lot of that. By cutting out intermediaries, they offer potentially much faster, much cheaper international transfers. This is a massive deal for people sending money home to developing countries, for example. Those partnerships we mentioned, like Circle and the banks, they're aiming squarely at this multi-trillion-dollar market. Even Visa and Mastercard are looking at stablecoin-linked cards now.
And they seem absolutely critical for that whole DeFi space, right? Decentralized finance.
Completely fundamental.
Right.
DeFi runs on stablecoins. They're used everywhere as collateral for lending and borrowing. You can lock up your volatile crypto, but borrow stablecoins against it to use without selling. They're also the main stable medium of exchange on decentralized exchanges, providing the liquidity needed for trading. Honestly, the stability they offer is crucial for the integrity of many DeFi apps. It lets people participate without constantly worrying about the value crashing.
What about bringing traditional stuff onto the blockchain? We hear a lot about tokenizing real-world assets, RWAs.
Yeah, stablecoins are key enablers there too. When you tokenize things like stocks, bonds, even real estate, put them on a blockchain, you need a way to pay for them on that same blockchain. Stablecoins provide that on-chain payment rail. This allows for incredibly fast settlement, minutes, maybe seconds, instead of days in the old system. And it makes trading these tokenized assets much easier, more liquid.
And of course, they still have their original purpose too.
Right, absolutely. They're still a vital tool for trading and hedging in the crypto markets. When things get choppy, traders jump into stablecoins as a safe haven to lock in profits or avoid losses without having to cash all the way out to traditional money. But while it's still important, the sources really emphasize that these new use cases, payments, DeFi, RWA, are increasingly what's driving the growth story now.
You also mentioned financial inclusion. How do stablecoins help people who are outside the traditional banking system?
This is a really powerful angle. They're proving super useful for financial access and inclusion, especially for people who are unbanked or underbanked around the world. They allow individuals to save, make payments, even access lending sometimes, often just needing a basic smartphone and internet. Think about countries with really high inflation or unstable local currencies.
Yeah.
Stablecoins pegged to something like the US dollar offer a way for people there to protect their savings, to transact with something that holds its value better. It gives them a measure of stability they just don't have otherwise.
So connecting this back to you, the listener, these aren't just abstract tech ideas.
Not at all. These are practical applications. They're making financial transactions faster, cheaper, and importantly, more accessible to people all over the globe. They're really acting as a catalyst for modernizing finance, kind of like a digital extension of regular currencies, especially the dollar, and pushing innovation in payments, DeFi, digital wallets, the whole ecosystem.
Okay, so as these things get bigger, more integrated, regulation obviously becomes a massive topic. What's the regulatory scene looking like globally in this sort of 2023-2025 window?
Yeah, it's really heating up. There's been a significant acceleration, a real intensification of regulatory efforts worldwide. And it's directly because of this growth, this integration with traditional finance. Regulators just can't ignore them anymore.
What's the story in the US? It feels like there's lots of talk, maybe slower action compared to somewhere like Europe.
In the United States, yeah, federal legislation has been moving forward, but maybe slowly.
Hmm.
You hear about bills like the Stable Act, the Genius Act. They seem to be focusing on what they call payment stablecoins, basically. One's used for payments, redeemable one for one. Key ideas in these bills are things like mandatory 1.1 reserves using high-quality liquid assets. They want monthly public reports, audits, pretty standard stuff for financial oversight. They're talking about a dual federal-state licensing system. Interestingly, these bills often propose prohibiting interest payments on these payment stablecoins, trying to keep them separate from bank deposits or securities. And they aim to clarify they aren't federally insured like bank accounts.
And different agencies are involved too: OCC, SEC, CFTC.
Exactly. That adds complexity. The OCC, which oversees national banks, has said banks can engage in some crypto activities, including stablecoins. The SEC, the securities regulator, has taken different views, sometimes seeing stablecoins as securities and bringing enforcement actions. And the CFTC, for commodities, sees them potentially under its jurisdiction, too. So while there's momentum towards some kind of federal clarity, which banks and businesses really want, this fragmentation among the agencies is still a big challenge.
Okay, what about Europe? MiCA sounds like a really big deal over there, a comprehensive framework.
Yes, the European Union definitely took a big step with MiCA, the markets and crypto assets regulation. It covers the whole crypto space, but has specific, quite strict rules for stablecoins. They categorize them as asset reference tokens, ARTs, or e-money tokens, EMTs. Those rules kicked in around June 2024. MiCA demands strict 1.1 backing with safe liquid assets. It even mandates a chunk of reserves be held specifically in bank deposits. Issuers need EU authorization, they need monthly disclosures, audits. It's pretty thorough.
So it provides clarity, but it's tough.
Very much so. The rules are strict enough that some exchanges started removing major stablecoins like Tether from their EU platforms to ensure they comply, especially around things like where the reserves are held. The broader MiCA rules for service providers like exchanges come online late 2024, early 2025.
And the UK, doing its own thing post-Brexit.
Right. The United Kingdom is building its own regime. They had proposals out late 2023, confirmed late 2024, and draft laws came out around April 2025. They're defining regulated activities like issuing qualifying stablecoins, specifically 1.1 fiat-backed ones, and running exchanges that handle them. Firms doing this will need the nod from the FCA, the Financial Conduct Authority.
What about Asia? It's such a massive, diverse region.
Yeah, Asia's more of a patchwork, but definitely seeing progress in key hubs. Singapore put out a framework in 2023, focusing on stablecoins pegged to its currency, demanding 100% reserves, redemption at par. Japan has a clear legal framework, requires registration with their FSA. Hong Kong is pushing hard to be a crypto hub. They passed a bill around May 2025 that requires licenses from their monetary authority, the HKMA, specifically for HKD-backed stablecoins. They're setting stringent rules on capital reserves redemption rights. But then you contrast that with places like China or India. They seem much more focused on their own central bank digital currencies, their CBDCs, and are generally more restrictive towards private stablecoins.
So why does all this regulation matter to the average person or a business thinking of using stablecoins? What's the real impact?
Well, it's arguably the main driver for mainstream adoption. Having clear rules builds trust. It makes stablecoins seem less like the Wild West. And critically, it gives traditional financial institutions, the banks people already use the confidence and the framework they need to start offering stablecoin services themselves. Compliance becomes more standardized, often using special software, reg tech. It reduces that ambiguity, makes them more predictable for everyone.
That makes sense for getting big players involved. But do the sources talk about downsides? Could all this regulation, especially the different rules everywhere, actually hurt innovation or make it harder for smaller companies?
Oh, absolutely. That's a major challenge the sources highlight, this jurisdictional fragmentation. The fact that the U.S. has its internal debates, the EU has MiCA, Hong Kong focuses on each KD pegged, China goes CBDC. It creates this complex, messy patchwork of rules that makes it really hard for stablecoin issuers or businesses using them to operate seamlessly across borders. Compliance becomes a massive headache. Even defining what is a stablecoin can differ, or who exactly regulates it. So it's definitely not a smooth global playing field yet, and that complexity can stifle certain kinds of innovation or favor the really big players who can afford the compliance burden.
Okay, so clarity is good, making things safer, more usable. But navigating this global regulatory maze is a huge task for the industry. And that ultimately affects how and where you, the listener, might be able to use them. and maybe limits what kinds get developed. Now let's flip the coin. Stability. Despite the name, these things aren't always stable. The sources detail some pretty significant risks and actual depegging events where they lost their value.
Yeah, this is absolutely critical to understand. Stablecoins, despite the goal, despite the name, they face real risks. Based on how they're designed and run, they are definitely not risk-free.
Let's revisit those risks we touched on, linked to the types again.
Okay, so for fiat-backed ones like USDC or Tether, the big risk is always the reserves. Are they really there? Are they accessible? Are they managed properly? If not, the peg can break. The Silicon Valley Bank collapse in March 2023 was a perfect, scary example. USDC temporarily depegged because Circle had $3.3 billion of its reserves stuck in that one bank.
Right, counterparty risk, trusting the bank holding the money.
Exactly. You're not just trusting Circle, you were trusting SVB too. And, as always, lack of transparency about reserves erodes confidence fast and can trigger selling pressure.
And the crypto-backed ones, like DAI.
For crypto-backed stablecoins, even though they're over-collateralized, a really severe fast market crash could potentially overwhelm that buffer. If the collateral's value drops too quickly before the system can liquidate it, you could see a depeg. Plus, there's always the technical risk of bugs in those governing smart contracts. And then, as we discussed, algorithmic ones are the most inherently fragile. They rely on these complex, sometimes brittle mechanisms, no hard collateral. So they're super vulnerable to speculative attacks or the arbitrage mechanism just breaking down or just plain old fear, a bank run, a loss of confidence.
And UST were the prime example of that model just imploding.
Catastrophically. The Terra USD collapse in May 2022 wiped out over $50 billion. Just gone. It was a devastating failure of the algorithmic model, showing exactly what happens when confidence evaporates and there's nothing concrete backing it. A digital bank run in its purest, most brutal form.
Are there other, more general risks that cut across all types?
Yes, several. Collateral management is key for any backed stablecoin if the assets are poorly managed, illiquid, too risky, doesn't matter the type. Stability is threatened. Centralization risk is big for the main issuers like Tether and Circle. If the company itself runs into trouble, it's a single point of failure. Trust and transparency, we keep coming back to that. If people doubt the reserves, doubt the audits, doubt the issuer statements, confidence goes, the peg goes. Technical vulnerabilities, smart contract bugs, issues with oracles which feed external data, network congestion can all disrupt things, and market manipulation like wash trading can be used to artificially distort prices.
And things happening in the wider crypto world can spill over.
Definitely. As stablecoins get more intertwined with traditional finance, volatility in crypto can have knock-on effects. The failure of a big exchange or another major issuer could cause ripples, maybe even cascading failures. The sources even mention something interesting. Because the big stablecoins hold so many U.S. Treasury bills in their reserves, large flows into or out of stablecoins could actually start to influence traditional markets, like Treasury yields. It shows their growing footprint, their potential to affect things both ways.
Okay, let's talk specific depegging events mentioned in the sources. Beyond UST, which was total collapse, what other wobbles have we seen?
Right, even the big established ones have had shaky moments. Tether, USDT, the biggest, dipped significantly back in October 2018, down to like near 90 cents amid rumors about its reserves. It also wobbled again in June 2023, less severely down to maybe 0.977s due to heavy selling pressure in the market. The USDC and DII incident in March 2023 tied to SVB is really important. USDC dropped to around 0.88 cents because of that $3.3 billion exposure. Yeah. And because DAI at the time used a lot of USDC as collateral.
It got dragged down too. Exactly. DII depegged as well, showing that interconnectedness risk. Now, both recovered fairly quickly after the government stepped in regarding SVB deposits, but it was a stark reminder of counterparty risk and how contagion can spread between stablecoins. And true USD, TUSD, another one, dipped significantly in January 2024, down below 93 cents. That was tied to worries about its reserves, plus Binance removing some of its trading pairs and some regulatory issues with its parent company.
So the big takeaway from all these examples seems pretty clear. It really is. These events hammer home that fragility exists. Uncollateralized ones like UST are obviously high risk, but even backed stablecoins face danger if their reserves are poorly managed, concentrated in risky places like SVB was, or if transparency fails. Stability isn't just given by the name or the marketing hype. It has to be constantly earned and maintained through solid design, transparent operation, truly liquid and safe backing, and good risk management. And these incidents also flash warning signs about potential systemic risk. Right now, the fallout has mostly been contained within crypto, But the USDC-DAI link, the UST market impact, they show contagion is real. As stablecoins get bigger and more linked to traditional finance, the sources warn that a major failure could potentially cause much wider economic problems if the risks aren't managed properly.
So, connecting back to you, the listener, while stablecoins offer promise, you absolutely have to understand these risks. Know the history, know the failures, do your homework on the specific stablecoin you're thinking of using. Its backing, its transparency, its track record, it all matters. Okay, looking ahead now. Stablecoins aren't the only digital currency story. There's this whole other huge discussion around CBDCs, central bank digital currencies. How do they fit into this future picture?
Right, that's the other major player shaping the digital currency landscape.
Mm.
And the dynamic between private stablecoins and state-issued CBDCs is really fascinating. They have some things in common, but they also represent fundamentally different ideas about money.
Where do they overlap? What's similar between stablecoins and CBDCs?
Well, on the surface, both are digital forms of money. Both are meant for payments, for settlement. Both aim for stability. CBDCs are inherently stable, being the digital version of the national currency, and stablecoins try to be pegged to it. Both could offer faster, cheaper transactions than old systems, and both will be subject to regulation or oversight, though the source of that oversight is totally different.
Okay, so what are the key differences? This feels like where the real philosophical split is.
Exactly. The number one difference is the issuer, the authority. A CBDC is issued and backed directly by a country's central bank. It is sovereign money, like digital cash from the government. Stablecoins, usually issued by private companies. The backing is different too. A CBDC has the full faith and credit of the government behind it. Stablecoins rely on those reserves we talked about, cash, bonds, whatever, and the quality and access to those reserves can vary. And this all ties into their core philosophy. CBDCs are generally a top-down, centralized government project, designed potentially for monetary policy, financial stability, maybe increased visibility into transactions. Stablecoins, they mostly came from the bottom-up crypto world, emphasizing accessibility, working across different platforms, user autonomy, often with a nod towards decentralization, even if the biggest ones are run by central companies now.
So it sounds like they could end up competing in some ways, but maybe also complementing each other?
That's the conclusion a lot of the sources point towards. They definitely compete in some areas. Stablecoins are challenging banks on payments. CBDCs are seen by central banks partly as a way to stay relevant and offer a state-backed digital option against private currencies. But a hybrid future where they coexist seems most likely. Stablecoins might serve specific niches, maybe in DeFi that a CBDC isn't designed for. You could even see integrations eventually. Banks themselves will probably need to handle CBDCs if they launch, their own tokenized deposits, and regulated stablecoins to meet all the different customer needs.
How far along are countries actually building CBDCs? Is this happening fast?
Progress has definitely sped up globally between 2023 and 2025. Something like 94% of central banks are doing something research, pilots. 11 countries have actually launched one, mostly smaller economies so far. Over 3 dozen are running active pilots, exploring different designs, cross-border uses. China's probably the furthest along among major economies with its digital yuan, the ECNY, which is expanding. Europe's working hard on a digital euro concept. Brazil, India, Nigeria have initiatives underway. But let's be realistic. The sources generally agree that widespread rollout, especially in places like the US, is likely still years away. There are huge technical hurdles, big legislative questions, and ongoing debates about privacy control. It's complicated.
So that philosophical divide you mentioned, state control versus maybe more user autonomy. What does that really mean in practice? How might they function differently?
It means they're not just interchangeable tools. They serve different interests, potentially. A CBDC could give governments new tools, maybe for targeted stimulus, maybe for getting really detailed economic data. But stablecoins, especially the regulated ones, are already doing some of the things CBDCs aim to do, like boosting financial inclusion, cutting transaction costs, making digital dollars accessible globally. They're doing that now without waiting for a multi-year government project. So in a way, stablecoins are acting as this private sector catalyst. While the U.S. debates a digital dollar that's years off, regulated stablecoins are already moving dollars efficiently on blockchains today. They're expanding the dollar's reach by embedding it in all this new financial plumbing payment apps. DeFi, digital wallets. They're not just waiting around, they're actively shaping the landscape, sometimes fulfilling the proposed functions of CBDCs already, and pushing innovation.
So you're watching this incredible race, maybe a partnership, unfold between state money going digital and private money going digital. And both are fundamentally changing how value moves and how we interact with money. Okay, let's wrap up by looking ahead. What are some of the emerging opportunities for stablecoins? The sources suggest they're not standing still.
Not at all. Innovation is definitely continuing, pushed by market demand, and also shaped by this move towards regulation. One really significant area highlighted is yield-bearing stablecoins.
Stablecoins that pay you interest.
Essentially, yes. They offer holders a return, maybe earned from the underlying reserves, maybe through DeFi lending strategies. And they've grown fast. The sources mentioned they hit around $11 billion in circulation by May 2025, up from just $1.5 billion at the start of 2024. That's like 4.5% of the whole stablecoin market already. Platforms like Pendle are built around this idea.
That's interesting. It tackles that issue of issuers keeping the interest themselves.
Exactly. It tries to pass some of that yield, potentially billions globally, back to the actual holders. It's also attracting regulatory attention. The sources note the SEC is starting to look at some of these as potentially certificates, subject to securities rules. It shows stablecoins are evolving into more sophisticated financial products. Another area is what's called programmable treasury for businesses. Using stablecoins combined with smart contracts, companies could automate really complex payments or financial flows, like payments triggered automatically when certain real-world conditions are met, streamlining operations way beyond just sending money.
And that institutional adoption we talked about, banks getting involved, that's expected to keep growing.
Oh, definitely. Continued institutional adoption is seen as a huge opportunity, especially in B2B payments. Cross-border settlements, we saw the $36 billion B2B volume figure. Big payment firms, big banks, they increasingly see stablecoins as strategically important for offering faster, cheaper international services. Banks are actually well-positioned to be the main way businesses access regulated stablecoins, helping them avoid the complexities of dealing directly with crypto platforms. For these institutions, the sources suggest, it opens up new revenue, helps them reach underserved markets, makes interbank stuff more efficient, and as they get more comfortable, you might even see stablecoin infrastructure become a new kind of asset class for institutional investment, especially as the rules get clearer.
Wow, so they could drive even bigger changes in how traditional finance works.
It seems likely. Their role in DeFi is pushing open finance. Your use in tokenizing real-world assets is creating totally new digital markets. The overall outlook seems pretty robust. Deeper integration, creating new structures, and really fostering competition and innovation across the board in finance and payments.
So, for you listening, keep a really close eye on these developments. Yield-bearing stablecoins, programmable business uses, banks getting deeper in. It could change how businesses run, how you earn on digital assets, and how your own bank interacts with this whole new world. We have covered a lot of ground in this deep dive today. We've seen stablecoins go from this crypto niche thing to, well, a major force in global finance, driven by that explosive growth. Remember the Visa Mastercard stat? And their uses just keep expanding.
Yeah, key takeaways. Remember, stability isn't automatic. It really depends on the design. Fiat-backed versus algorithmic. The USD failure is the ultimate cautionary tale there. And regulation. It's absolutely crucial for mainstream trust and integration, but that patchwork of different rules around the world is a real headache, a big challenge.
We also saw they're even having a macroeconomic impact now, influencing treasury markets with their reserves, potentially boosting the dollar's global role via digital rails. And they're in this fascinating dance with CBDCs, sometimes competing, sometimes complementing, often shaping the future of digital money before the central banks even get there.
Absolutely. They are actively modernizing payments, helping with financial inclusion in many places, and just becoming this core integrated piece of the financial system faster than many people realize.
Okay, and to leave you with something to think about, here's a provocative thought based on everything we've discussed. Stablecoins started with this sort of vision, right? Tied to crypto's roots of decentralized finance, maybe financial autonomy, an alternative system. But as they grow, as they get deeply integrated into traditional finance, as they become heavily regulated, often issued by big centralized companies, backed by bank deposits or government debt, are they really fulfilling that original decentralized vision anymore?
Or are they actually morphing into something fundamentally different? Maybe a highly regulated, efficient, but ultimately less autonomous digital extension of the existing financial system.
Something to definitely mull over as you watch this space evolve.